Welcome to Views from the North, a Canadian rates and macro podcast. This week's Canadian economic data calendar is on the light side. Instead of the usual format, I've decided to include a panel that I moderated last week as part of BMO's Government Reserve and Asset Manager Conference. The panel was titled Capital Flows in a Time of Stress and featured Manmit Pandori, MD and Head of Tactical and Accrual Trading at BMO Capital Markets, Avi Hooper, Senior Advisor at ABP Invest, and Matthew Emde, Director General of Funds Management for the Government of Canada. I'm Ben Reitzes, and you're listening to Views from the North. Each episode, I will be joined by members of BMO's FIC sales and trading team to bring you perspectives on the Canadian rates market and the macroeconomy. We strive to keep the show as interactive as possible by responding directly to questions submitted by our listeners and clients. We value your feedback, so please don't hesitate to reach out with any topics you'd like to hear about. I can be found on Bloomberg or via email at benjamin.reitzes@bmo.com. That's benjamin.reitzes@bmo.com. Your input is valued and greatly appreciated.
Morning, everybody. My name is Benjamin Reitzes. I'm hosting the first panel this morning, Capital Flows in a Time of Stress. You may remember me from 2 days ago when I talked a lot about Canada. I'm the Canadian rates and macro strategist for BMO, and I'm the moderator. I'm going to let my panelists here introduce themselves, starting with Matt here.
Good morning, everyone. Nice to be here. I'm Matt Emde, Director General of Funds Management Division at the Department of Finance, Government of Canada, responsible for debt management, reserves management, and crown borrowing.
Good morning, everybody. My name is Avi Hooper. By background, my professional experience is managing global fixed income and currency portfolios. Today, I'm a senior advisor with ABP Invest. We're an independent advisory based in London, England, supporting global institutional investors, bringing together geopolitics, markets, and economics.
Good morning, everybody. Manmit Pandori. I run the Tactical and Accrual Trading team here at BMO.
All right, so take things off. I'm gonna try and set the stage here. So we have discussed this a little bit so far at the conference. The past month has been, I can't believe that anybody here has experienced the type of volatility that we've seen in the past month and the types of swings in the markets that we've seen. It is arguably unprecedented in the way that it's unfolded, and the way that it's unfolded, the reasons it's unfolded. This is self-inflicted wounds here by the U.S. Policy-driven, trade tariff uncertainty-driven, and equity market, rate markets have swung wildly back and forth over the past month. We're interestingly kind of back where we started, which I guess you probably wouldn't have thought the day or the week after for April 2nd, but here we are. One of the overriding takeaways for me through all of these swings has been that the US dollar just has not performed the way that you thought it would. US assets have not performed the way that you thought that they would. That's been the one thing that I can say that I can take away from all this, because the rest has kind of just been noise, quite frankly. I mean, stocks going down, then back up, rates every direction, you pick the day. And Treasuries, the other part of that, Treasuries have come under a little bit more pressure, I think, than what you would have expected in this type of event, in this type of stress. Historically, you get safe haven flows into Treasuries, into dollars, and that just really has not been the case over the past month. So whether this reflects a loss of faith in the U.S., loss of faith in the dollar, Treasuries, or maybe markets are just seeing what is coming down the road, slower trade flow, different trade flows, and maybe just fewer flows on that front, driving a little bit less demand for dollars. So I'm going to start with Avi. I've tried to set the stage here. There's been plenty of chatter on dollar diversification, or diversification out of the dollar, and that narrative in general. What are your thoughts here, given your background? Has the U.S. dollar entered inevitable decline?
Well, let's start off with the noise, right? A couple of weeks ago, we got the famous Economist cover, which said exactly that. The last couple of days, the times I've heard the word de-dollarization, I actually need two hands. So the point is, in the near term, yes, there's a lot of noise, but the reality is this is a massive, deep, liquid market, and there really today isn't an alternative. That said, we should look at the structural backdrop of reserve currencies. And so for that, I would reference the International Monetary Fund's COFR report, which has shown that the US dollar as a contribution to global reserves has been in a bit of a glacial decline. Today, the latest report shows that the allocation is actually only 57% in US dollars. keep in mind that 57% weight is the current and captures the valuation of the US dollar today, which we would all agree, based on a variety of different valuation methodologies, the US dollar is overvalued. So 57% of an arguably overvalued currency is the current weight. That's the structural backdrop. So it's still large, but we must recognize that it is reducing in significance. That's the structure. Cyclically, if I could just add, with what's going on today in Europe, but more specifically, if we look at the euro, the currency, it's less so much that it's rallied against the US dollar. In fact, what we're more focused on is the appreciation against the Chinese renminbi. What this means in our view is that Europe, in the Eurozone, it will be importing China's deflation. This is going to be supportive, in our view, for the ECB to ease monetary policy much further, and certainly much further than the Fed. We would say, wow, the relative interest rate differential should be negative. We believe the focus from a cyclical perspective should be on the relative growth expectations between, for example, the Eurozone and the US. Because if the ECB is able to stimulate with the bazooka that has been announced by the German government in terms of fiscal stimulus, this, we believe, could support trade and investment flows into Europe, which clearly are lagging the capital flows. I'm sure you've noticed the massive rise in appreciation in the euro. That's what happens first. Capital gets repatriated, but we're presenting what we believe is a fundamental cyclical argument for Europe and investing in the euro. For everybody here in Toronto, in our view, the puck is in Berlin.
Thank you, Avi. Manmit, I'm going to move to you to take more of an investor view here. How do you view the risks to the dollar, and maybe to some extent treasuries? When you've gone through periods of market stress in the past, I assume you've leaned on treasuries. Are you still doing that? And is there any talk of diversification among you and your peers?
Yeah, I mean, I think that's obviously a very pressing topic for most investors at this stage, but I think at the moment it's just, very difficult, like Avi mentioned, to really find a deep liquid market that you can kind of diversify into. And so it becomes, I think, a bit challenging to, envision something where you're going to not have dollars or not have, US treasuries and things like this as a big part of your portfolio. Obviously there's been a huge rise in gold prices and some of these other alternatives, but, those are, I think, still limited or, are finite naturally. And so, being able to diversify away from dollar-based assets is just a very, difficult thing to comprehend. Like Ben mentioned before when he started, treasuries have been trading very heavy, over the last, I would say, month or two. And, they've become a little bit of almost like a spread product, I feel. But I do think, as the market calms down, as some of the rhetoric and some of the extreme kind of discussions cool down, dollar assets will kind of return to being the more safe haven assets that they are. And I just don't really see that changing just because of the deep kind of liquid market that they are. It's very hard, especially for, I'm sure for a lot of the portfolio managers in here, when you have such a large portfolio, to really find anything else. I'm sure, you can have on the margins, have other asset classes and other currencies as part of your portfolio, but really finding a full alternative is just, I think at this stage, a bit unrealistic.
Fair enough. Early stages, perhaps. Also, I guess the fact that we're a North American bank means that we're somewhat captive to North American products.
If I could just add there, I agree with the points. I think, a lack of an alternative is the big issue. And just to go back a bit to some economic history, if I've got it right, I think we've seen evidence that global monetary systems moved very slowly. So the UK, back when it was the global superpower and the world's reserve currency, even after it lost its economic status in the world and the US had overtaken it, the sterling remained the world reserve currency for a long time after. So I think, the US is still the economic superpower, and there's an alternative there. And so even if it does lose that, it could still maintain its status for a while. So that's kind of, I'm in the camp of probably continued but slow move away from the dollar, but probably not sharp movement. Yeah.
I would just toss out there. I'm going to add my opinion too. Just I'm the moderator, so I can do what I want. I think if you think about it from a kind of a geopolitical perspective, probably maps out pretty well to that as well. Like the dollar peaked in the early 2000s when the US was the world superpower and they ran fiscal surpluses. Things were great in the US through the tech boom, and then things kind of went a bit sideways after that. But that is when things were probably at their best for the US, and the US was the unquestioned strongest country in the world. There was no question at the time. Things have changed. Obviously, China is far stronger now than they were, far larger of an economy. I mean, facilitated to some extent by the U.S., by U.S. consumption. And so the changing geopolitical dynamics, I think, the increasing multipolarity of the world also means at the same time that you get a little bit less U.S. dollar dominance. And as it's assuming that continues to unfold, assuming you get trade continuing to diversify among the world and be kind of less U.S. centric, that also means the dollar plays a little bit less of a role. I think trade flows are, through all of this, kind of the really the underpinning behind all of it, behind all the U.S. dollar demand and everything. And as I'm not really sure where tariffs end, but as it diverts trade flows elsewhere, it is also going to divert capital flows at the same time. Now, whether that's in times of stress or not, I think that's just kind of a bigger trend that we get over the coming many years. Next question here, Matt. Your perspective is different from our other panelists. You're on the issuer side. How does the government of Canada position themselves with international investors? Given the stress we're seeing in markets, is the government out there saying, like, look at us, we're AAA mostly, and we have strong fiscal dynamics, strong government. We are a trusted partner. Come buy our debt. Is that a selling point? Is that out there?
Yeah, thanks for the softball question. Yeah, that's totally what we're doing. I mean, I'd say Canada has a very strong story to tell. We're in a position of strength to benefit from any dollar diversification to the extent that it's happening. Preaching to the choir here, but I mean, one of the handful of countries that they're AAA rated, wealthy, diverse economy, stable banking sector, credible monetary policy, a fiscal situation that's the envy of many countries. We've seen recently, stable institutions. We can manage transitions of power fairly seamlessly. And then, we can offer deep and liquid fixed income markets, whether govies or provies or CMBs. So yeah, this is the message we're bringing to the market. I've got this question a number of times over the past couple of days. Have we seen evidence yet of increased investor demand given this potential shift? And what I've been saying is, anecdotally, yes, a few stories about some increased investor inquiries, including from new accounts or accounts that maybe used to buy Canadian a number of years ago and stopped. So that's positive. I'd say small right now. We'd expect that any such shift would be probably start small and build, and probably just be in the secondary market. So no evidence. I'd say too soon to look at our auctions and expect any evidence there. But
No federal and U.S. dollars?
Well, we issue a global U.S. dollar bond once a year. It's for our reserves portfolio, $3 to $4 billion. We've been kind of a staple in the market, doing it every year for a number of years now. But it's got a very specific purpose. It's for our reserve portfolio. The vast majority of our debt, domestic program, is Canadian dollars. Yeah.
Would you look at issuing in other currencies?
We've got that question often too. So taking a step back, like, what's the purpose of our reserves portfolio? The primary purpose is to be able to intervene in foreign exchange markets to support the Canadian dollar if we need to. Well, the U.S. continues to be the vast majority of our trading relationship. If we needed to intervene, it's likely going to be, selling U.S. dollars. So, we need to maintain U.S. dollars, a key part of our portfolio. And the other element is we have, it's just once a year. Investors have come to expect it. It's also kind of our U.S. dollar issuance machine is well oiled. And U.S. issuing in euros right now is a little more costly. So all those factors continue to suggest that the U.S. dollar is the most obvious currency for us to continue to invest in or to issue in. We're, constantly looking at the options. But for now, we're not actively considering euros or other currencies. Yeah.
One more question for you. Post-election, the Liberals have their platform out there, so we know that will not be the budget, but it is, I would argue, I guess, the framework for the budget. You've already increased your borrowing sizes for this year before the budget, and there is likely more spending coming, so that suggests we could get even more borrowing, potentially. What have the rating agencies, I guess, discussed with you, let's say? Is there concern about the risk of Canada getting downgraded debt from AAA?
Yeah, good question. Well, as Graham Johnson already said once at this conference, Canada is keenly aware of the privilege of our AAA status, the benefits we accrue from it, and we definitely want to maintain it. So what have we, in our discussions with the credit rating agencies, I think the one thing that we start with and that they understand is we're facing this situation from a position of fiscal strength. We're in an enviable position with deficits, debt to GDP, lowest in the G7. So yes, we're looking at potentially some incremental fiscal slippage, but starting from a position of strength. The second point I'd make is, and the credit rating agencies, their focus is not on the near term. They know there's going to be some slippage in the near term. What they want to know is it going to lead to persistently higher deficits over the medium term? Or can we demonstrate we have a plan to get things back on track? And so that gives me some comfort that there's not going to be a knee-jerk reaction. And just on that, I point out that in the Liberal election platform, they did talk about maintaining a kind of a fiscal anchor of the debt to GDP ratio declining over the medium term by the end of the budget horizon. So, which was similar to the previous government's fiscal anchor. So, bottom line is, I think, yes, there will be some fiscal deterioration in the near term. Don't expect it will be sustained over the medium term, which gives me some comfort that we can maintain our AAA rating. Yeah.
One of the interesting dynamics of it, what's going on here is you have the U.S. running this massive deficit, and the consistent narrative from the U.S. is the Treasury market's the deepest, most liquid market in the world. It is not replaceable, which it is not. However, what we're seeing is a little bit more fiscal policy from policymakers globally. Like, there is more drive toward fiscal stimulus, be it Germany, be it Canada, be it wherever. That creates more assets to invest in those currencies. It kind of facilitates that transition, not necessarily away from U.S. dollars, but some diversification probably on the margin toward other currencies in other countries. How much appetite, how much acceptance is there going to be of that, Avi? I'm going to start with you there. There's so much concern about the U.S. fiscal situation, and we're talking about Canada's rating and concerns there. And I guess Germany probably is a bit of an outlier in that, they have tons of room. They can go for a while before anybody cares. But there does come a point where it's just too much. And so, where's the balance there?
Well, if I could, I think we should take a step back. I mean, fiscal stimulus really is most effective and has been over the last 15 years when the central bank has introduced unorthodox monetary policy. Quantitative easing actually originated by the Bank of Japan. But it was Ben Bernanke, for those not familiar, Ben Bernanke was a central bank governor of the U.S. Federal Reserve during the financial crisis. In 2002, he wrote a seminal piece criticizing the Bank of Japan because the MOF, the Ministry of Finance of Japan, did not cooperate and coordinate with the efforts of the Bank of Japan that was creating this excess liquidity. So fast forward to the U.S. financial crisis, a global financial crisis emanating out of the U.S., Ben Bernanke created the credit, but it was the U.S. government, which, if we fast forward, Janet Yellen became the central bank governor. She then became the Treasury Secretary. So there was a full understanding in the U.S. from Ben Bernanke's work on what it would take to really make quantitative easing effective. Germany, you highlighted, did not take advantage, right? We hopefully remember Mario Draghi, do whatever it takes. Central banks have had to do a lot, but what it really needs, what we all need, especially here in Canada, is the government fiscal incentives to invest. So I would pick on Canada because we know we're sitting here and our government historically has not been supportive of investing in our most valuable asset globally, which is our raw materials. We now export more gold than autos. We have the fourth largest gold reserves in the world. For those of you who may have missed, Bloomberg Media has this great podcast, Oddlots. A couple of weeks ago, they interviewed the pea protein king of Saskatchewan. You've got to listen to this. What's going on in our country using technology to leverage our raw materials is what I am really optimistic about. And when we think about Germany building out their defense sector, we're not talking about building tanks. What they need are the raw materials that Canada has. So we sit here, and I hope that in conjunction with easy monetary policy, which the Bank of Canada has been able to introduce, that we get finally, not just Germany, Canada, other countries recognizing what the US policy did so well on the back of unorthodox monetary policies. I'm not suggesting we return to QE here in Canada. What I want to see is more directed government policies that incentivize economic growth. We have a ton of excess capacity. So had to talk about the home tier.
I somewhat echo that. At QE, no thank you. I think we know where that goes. We know what happens when you mix monetary and fiscal policy, and that's not a road I think we need to go down again, at least from a societal perspective for sure. Swap spreads I think reflect a lot of the concern in the market, and that is one area where there has been plenty of stress in the U.S. Canadian spreads have continued to trend lower. This is kind of a global phenomenon. So the markets are cautious, I guess, on this narrative. And like how do you deal with that from a portfolio management perspective? Is it going to continue?
Yeah. For some background, our portfolio is mostly all asset swapped. And so, swap spreads are a very important piece of the risk that we manage. As Avi mentioned, or, as Ben has been talking about, I think the fiscal side of, the outlook in most of these countries where deficits are going to be, obviously very large over the next, number of years. I think it's obviously very reflective in the pricing, and you've seen extremely tight swap spreads in the US. And I think in Canada, over the last year, we've moved from, maybe plus 30 on swap spreads to minus 30. And so it's been a huge move. And, from our perspective, one, I think it offers an opportunity to really be able to, pick up that extra carry. It's that's a good outlook for us. But I do think that, some of these swap spreads are really here to stay. It's hard to envision a world where, we get U.S. swap spreads back to zero or, to a positive number in the near term. I think you need a lot of fiscal reform and, change in the budget outlooks to be able to do that. And, I just don't think there's an appetite to do that in the near term. So it's hard to see that kind of changing. But, I think over the last month, swap spreads and treasuries have just been trading very heavy. And I think it's led to, I think a worry a little bit of what kind of spread asset really this is, and concern where you might have had a very stable asset class that might be moving around at a 0.2 beta or something like that to credit or to equities, and now it's moving 1-for-1, and so clearly there's been a shift in that market dynamic, and I just don't see that changing, at least in the very near term. Over the course of a few years, maybe you get some more reforms and deficits look a little bit more reasonable, but until that time, I think it's just hard to see that really changing.
The U.S. is in a tough spot. Like you're running a 7% of GDP deficit. The economy is in pretty good shape, but at some point, like that 7% becomes unsustainable. So what happens when it goes down to 5 or 4 or 3? Like the negative impulse on growth from that type of fiscal contraction is real. It's material. But what that does is then it deteriorates your fiscal position at the same time because there's less money coming in the door. And so I don't know how that ends for the U.S. Like maybe we get some kind of big productivity boom and that really facilitates everything and things look great that way. But it is a tough spot to be in at this point. I think that's reflective of where the markets are, I think, to some extent, that there is this kind of trap the U.S. is in. I don't know how you get out of that hole, dig your way out of it.
One big splashing tax cuts all over it.
Maybe that works at the end of the day, but it hasn't worked so far. So, it is a really challenging episode, I think. Maybe one thing I wanted to ask, like, what are your favorite trades right now? Like, how are you dealing with this market volatility, this market stress? Is there anything in particular that you look at, any indicators that maybe bring you a little bit more comfort versus my kind of concern that we're may not be going in the best direction here?
Yeah, I think at the moment, a lot of our views in the team and kind of in the portfolio are playing more defense than offense, and just trying to make sure that we're getting paid for the risks that we're taking. And so I think some of those things just mean we're in more front end asset swaps, keeping our risk a little bit lighter than usual. It feels as though like the option tree of what can happen over the next 6 months is extremely broad, and I think market spreads and pricing is reflective of that. But I think for us, we try to stay a little bit, closer to home at the moment, keep that gunpowder. I think in past years where there's been more stability and you don't want to be really, short a lot of vol. It's at the moment now, I think, that gunpowder is worth a lot more than it's been probably any time in the last, 3 to 5 years. And so, keeping that risk capacity, I think, available is really crucial. And so, things that we look at now are looking at like break-even spreads for, an asset when we buy them. How much are we getting paid? How much do we have to worry about this thing widening over the next month to kind of get rid of our carry? But yeah, I think, at the moment we're in a lot of, front-end asset swaps, in a lot of steepeners with that kind of bias, just given, the outlook that we just discussed. I think some of those are kind of the right thematic trades to be in, and then, really just not overextending yourself into a market where, to be honest, like spreads are not that wide, and stocks are not really that low. So if things were, extremely cheap, I think you probably get a lot more comfort in getting out there and buying and feeling as though, you're getting paid for the risk that you're taking. Whereas right now it feels as though with, so much uncertainty and what can really happen over the next year, you're not really getting paid to take that risk, I would say. And so, we're keeping our risk pretty light.
I think that last part's the most interesting part of all what's going on for me. That's just like, think about the past month. Think about where spreads are, where credit spreads are. We are not too far from the tights on a number of different metrics. Stocks have retraced all of their declines, and on any kind of morsel of positive news, we're up 1% to 2%. And there's lots of morsels, and we'll see what President Trump says today about the U.S.-UK trade agreement. That's probably one of the easier ones for them to do here. But that it does make it really hard to want to put on more risk here. Personally, professionally, I think it is makes things pretty challenging from that perspective generally. Avi, I can go back to you. Are there any real alternatives to the dollar? Realistically, I mean, is it not for now, and then 20 years from now, maybe if the European market grows sufficiently, that's one, or maybe China creates its own little block. You get BRICS countries or whatever you want to pick a number of countries, and they just kind of move into the China sphere, and China becomes its own little financial superpower on its own.
Yeah. Well, I think we need to start off with the current global economic environment. We have moved and are likely to continue to move away from globalization towards desynchronization. And what do I mean by desynchronization? Implicitly, what I'm suggesting is what could happen between the US and UK today is more bilateral trade agreements. So what this means is there will be, and you asked, is there an alternative? Yeah, I mentioned the euro. If we want to go there and talk about gold, I'll take the 4. Everybody else, by the way, we had a pre-panel discussion where it's pretty clear, and we heard this from the Gold Council the other day, gold is seen, not to say as a currency, but as an alternative reserve asset that may, we don't know, be the backstop to another form of medium of exchange used by the BRICS countries. Right, a perfect example, when India imports oil from Russia, they're not settling in US dollars. Right? China is trading with many different countries. What is its trade with the US? It's in decline. So, I think about that and the opportunity that exists. So.
There is opportunity. I'll take the other side on gold. I mean, there's some merit to that, but replacing fiat currency with gold is, I mean, I can't put it in my pocket and buy stuff with it. I'm not going to the store and
but I think
giving out a gold coin.
Isn't it the collateral concept? Are we backed by paper or are we backed by a physical asset?
Physical assets can also be seized, which is part of the problem. And I think that probably is one of the issues as to how you store that, where you store that, the safety of that item. And I think that's part of what we've seen over the past 10 years when Russia invaded Ukraine. Their assets have been frozen, so on and so forth. So that I think makes it a bit more challenging. I'm happy to be run there. I'm happy to be challenged there. And Matt, you, I assume, have conversations with other countries about their issuance and their finance ministries similar to yourself. Are they thinking there's an opportunity here as well? Is this like a global thought here? Everyone is aware of the opportunity, and everyone is looking to global investors to get their piece of the pie.
Yeah, I mean, I think as we know, global borrowing is at very high levels, kind of at or higher than we were at the peak of the pandemic. So it's not just sovereigns, provinces in Canada, or pension funds. So everyone needs to borrow more, and we're all competing, and it's a lot of supply, and that's the challenge, right? I think, happily things have been absorbed quite well in markets, but it is a concern, right? Do we reach limits of that?
When you say we're at pandemic levels of borrowing, that worries me. Just that, and pandemic was so extreme that any comparison to that, when you say we're at that level of anything, that's makes me wonder if we're going in the right direction here. We'll leave it there. Thank you, everybody, and thank you to our panelists.
Thanks for listening to Views from the North, a Canadian rates and macro podcast. I hope you'll join me again for another episode.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.